Hey guys, alright, it's time for our weekly update here. I do my usual coverage of the S&P 500 earnings, bond market, bond yield information, whatever. Recommended stock bond mix. Some a little bit of info on the $100 billion plus market cap companies that reported earnings last week. These are just S&P 500 companies for you, just in case you're not really familiar with that. And for this week's economic data, we're just going to cover a couple of things here. One would be the Producer Price Index, which is also otherwise known as wholesale inflation data. We'll go into a few different details on that, and then we'll also cover retail sales and housing and building permits kind of stuff, the reports that came out later last week or in the week. So I'm trying to keep this on the generally short side if I can. I'll try not to go into too much great detail, but it will be some necessity there for that. So to help you, I hope you guys keep moving along where you want to be if you desire that. Don't forget, I always keep bookmarks in the video description. So you can, if you want to skip past something, maybe you think I'm rambling, or maybe there's certain information in here that is being covered that you're not interested in hearing about, you can go ahead and use those bookmarks to skip ahead. All right. Hopefully there's some kind of value that can be had from this in some way or shape or form for you otherwise though. All right. So that said, let's go ahead and move on to the data. All right, we're going to start with S&P 500 earnings summary information here that I always start with. As you see, my current values all went down by about 5 points, except for the three-quarter out period. That's remained unchanged at 49.70. Don't need to go and keep covering, going too much blabbery detail about that. You can see it for yourself. 12-month price estimate for where I expect the index to be valued a year from now, based on existing earnings data, would be it went down 15 points from 51.25 down to 51.10. Ideal trading range, again based only on earnings data alone, does not factor in economic factors or geopolitics or market sentiment. That went down about 5 points as well, topping out at 49.85 and bottom end of what I would call the normal range, about 48.10. Last week's updates, out of the companies that did update, I was expecting them to have a -2 effect on my current value here, and that's exactly what they did produce, was a -2. Due to rounding, I only need to work with multiples of 5, so it's kind of just enough to push it past the threshold. There is why you're seeing that. All right, so far, as you see here, we're at now 91.1% of the index reported now for the quarter. So only not even 50 more companies to go between now and the end of December. All right, and then change the CV, the current value since the beginning of the quarter is plus 78 points. And the percent of the companies that have reported positive earnings growth compared to the same quarter last year is it ticked down just a slight bit from 57.2 to 57.0. That's percent, by the way. All right, looking ahead, next 4 weeks. Very slow week. You see here 10, 9, 7, and 5 companies in each of the next 4 weeks. Only 31 total. Over the next month, pretty much. Only 6% of the index expected to give an update over the next quarter, over the next month. I mean, that's very slow. Don't know. We might get a little bit slower than that actually over the next couple of weeks. But once the early, more so in the mid part of January, starts to pop into the further out view here, you'll start to see it pick back up. But over the next 4 weeks, so only expecting a plus 8 effect on the CV. So it means don't expect this number to go up any higher than 49.30, maybe 49.35 between now and next month. Looking at stock and bond general data here, stock earnings yield for the S&P 500 remained unchanged at 2.54% positive. 10-year bond yield also remained unchanged. Did do some movement in both directions through the week, but it settled. It ended the week at the same level that it ended the previous week at, plus 3.82%. The 10-year versus 2-year bond yield curve that gets looked at so much actually steepened in a more inverted way. We were at 52 basis points inverted last week. We're now at 69 basis points inverted. So yeah, that does create concerns there. We'll go more into the bond yield curve when we get to that chart. And the average long-term bond yield. This is what affects what the growth rate is of the TSP's G fund. That ticked down just a tad bit from 399 to 396. My recommended stock bond mix remains at 40% stocks and 60% bonds. All right, looking at the $100+ billion market cap companies that reported earnings last week. We got Walmart, Home Depot, Nvidia, Cisco, and Lowe's. They all reported. The only one that missed my previous expectations was Nvidia. They were also the only one who reported year-over-year earnings decline. However, all of them, their forward estimates, forward-looking estimates that haven't been reported yet, but analysts are expecting, over the next 4 quarters, they all revised lower for the most part. Cisco was mostly unchanged, but there was just a slight tick downward on, I think, one of the quarters that I had previously up. And also, just as a side note here, Copart, they completed a 2-to-1 stock split since the last time I updated their earnings data. So doesn't mean they just did it this week. It just means that sometime between when they did their last earnings announcement and the one that they just did this week, they completed a 2-to-1 stock split. So what that did was it cut their earnings per share in half. We'll talk about that when we get to that particular screen. All right, summarizing, those same companies that you just saw on the previous screen had 4 beats and 1 miss. And of course, I already mentioned 4 of them reported earnings increases. Only 1 of them was a decline. And all 5 of them had downward estimate revisions. All right, this is the complete list of companies that reported, or that I did updates for from that reported last week, or this, I guess I should say this week. It's still Saturday. As you see there, the blue highlighted companies are the ones, or the stock symbols are the ones that I just talked about. Those are the $100+ billion market cap companies. And the ones that have their company names in peach colored cells are also members of the Dow Jones Industrial Average. So that helps you out there. I got 3 of the 30 stocks of the DJIA that reported. Now again, I think I reported all but one of these larger companies reported year-over-year increases in earnings. Nvidia, I think, was the only one that was down. Their estimates, if I recall, were revised downward by a pretty fair amount. Not quite 50%, but they were very noticeably down from what I previously had for them. So they're only projecting a 2% earnings per share gain over the next year now. And I talked about Copart. Right over here, let's see, they did a 2-to-1 stock split. So basically, if you double, when you do a 2-to-1 stock split, what you're doing is literally halving the earnings per share and also having the share price as well. So let's just say they were a $200 per share stock. Then at the end of the stock split, their share price will drop to $100. And then but you'll get twice as many shares. So the value of your position is the same if you own shares of them. And then their EPS, it got cut in half too. So previously they would have been at like 108, 109-ish, somewhere here on the 5 quarters ago. And then basically just double what all these numbers are, and that's about where they were at prior to the split. All right, now let's look at our screen of companies that reported last week, which I would call momentum buy plays, or worth considering for momentum buy. Had Target, Ross, and TJX, all retailers. Now, I would be a little bit more concerned about Target, though. They did not do so well with their earnings, and I think they were noticeably lower as well on their forward estimates compared to what I previously projected. Ross, on the other hand, they beat, and I think like I said, they looked pretty good on their forward estimates from what I recall, and that's what I had reported. No, actually, I think they went up. Yeah, they're not one of the $100 billion companies. Generally, the more discount retailers like Ross, Dollar Tree, and the likes of companies like that reported seem to be doing better. Target, Recall they missed, and they're down almost 50% from what they reported the same quarter last year. And I recall all these forward estimates being up higher than they very noticeably higher than they were before as well. So that would be a little bit more concerned. They have the wrong momentum going for them. Yeah, but now Ross, like I said, they were the opposite case. Their earnings were down, but I recall they beat what if I recall, they beat what I previously expected, and I want to say their estimates went up as well. So that could actually be a good thing for them. TJX, that's another discount retailer. I didn't pay much note to what they did. Their earnings were up just a slight bit though, and they're still expecting almost 13% EPS growth. Moving on to the contrarian buys here. These are the ones who are losing it on their earnings by double-digit amounts. Now, these are the ones where you can take advantage of opportunities, dollar cost average, more shares of their stock for the same amount of money invested, and with the expectation that hopefully won't be too long before maybe they turn the corner and head back to the north. These three here are Tyson Foods, Bath and Body Works, and Applied Materials. I do a lot of Tyson loads myself, but now a couple of loads that I did recently, I had the impression that they were actually pretty busy, but no, so I don't know what's really going on with their I don't know their actual numbers. I'd have to look more deeply at them. Again, and I'm also not an insider. I just kind of giving you my perspective from a driver's end of dealing with Tyson loads myself and going to some of their facilities and kind of observing stuff. But so I'm not sure why their EPS growth would be so bad. Yeah, there could just as well be a case of they're more exposed to foreign markets, and I know that to be the case because I've personally taken some of their product to port areas like Oakland, where they'll eventually end up in China or Japan or other countries. So I know they have a presence in foreign markets. So I don't know, foreign currency exchange rates, maybe that had a factor in that. I don't know. But either way, people need their food, and I think they're a good long-term buy personally myself. I would definitely strongly consider them as a contrarian buy for myself personally. All right, and looking ahead to this week's earnings that are expected, I have two of the $100 billion plus market cap companies. First one will be Medtronic Public Limited. That's stock symbol Mike Delta Tango, MDT. They report Tuesday. They aren't expecting much though. 7% EPS growth over the next year. Currently, I'm expecting $1.28 per share from them. They reported $1.32 the same quarter last year. So I'm expecting a slight decline in earnings from them. And looking at the Wednesday, got Deere and Company, John Deere, of course. They are expecting to report an increase in earnings, and they are expecting strong EPS growth over the next year of almost 35%. That'll definitely be one to pay attention to. All right, let's look at the bond market now, or bond yield curve more particularly. This week, now bond yields went up, and I think in the early part of the week, but then they came back down, and that would be because of the producer price index, or the wholesale inflation data coming in weaker than expected, which I will talk about. That caused some interest, some buyers to come into the picture on the long-term bond yields, because higher inflation demands higher bond yields, and when you get softer than expected inflation data, it has more of the stabilizing or downward effect on especially long-term bond yields. The shorter-term yields over here are more sensitive to Fed rate decisions, and I've talked before. The current yield on or the Fed funds rate is not the yield, but the Fed funds rate is currently in the 3.75 to 4% range. So we're well within that range now on the 1 month bond yield. Again, I've talked before, the 1 month yield gives a lot of predictability about, or a lot of predictions about what to expect the Fed to do on an upcoming rate decision. They're getting up closer to the higher end of that 3.75 to 4% range now. So, and I do expect it to go higher. I think an argument can be made for pausing rate hikes, but there is reason, the data also that will support kind of justify the Fed continuing to raise rates a little bit more as well, which we will talk about also in this presentation here. But over the coming weeks, I do expect this 30-day yield to climb up higher to at least 4.25, maybe even 4.5, because there's been a lot more talk about the Fed raising the rate to by at least 50 basis points on the next rate hike, or on the next meeting in December. I think 75 basis points is too much, personally, but I can see definitely some argument, at least, even if I may do or do not agree with it. I'm on the fence on about myself, but yeah, I do expect at least a quarter, maybe even 50 basis point rate hike by the Fed coming up. So I do expect these short-term yields to climb even higher, and these short-term yields are up higher than the long-term yields. That is a concern, because that's going to tighten up borrowing. I'm going to talk about that as well when we get to the home sales, or the mortgage stuff, the economic data that I'll be talking about toward the end of this presentation for you. All right, let's move on to the economic data now. Let's start with the usual initial jobless claims. We're looking for any kind of evidence of a spike in jobless claims here that are being filed. Not seeing anything really worse than expected, even with the recent announcements of layoffs by Amazon and Meta, and previously mentioned by Twitter. There's a lot of jobs that are being lost by that, but they're not really showing up so much in the jobless claims data yet. And there's belief that they won't show up too much in here, because there are other tech sector companies. Amazon's not technically a tech sector company, but they're kind of intertwined with it. Either way, though, there are enough tech jobs in both those companies that there's a belief that they will probably, a good number of those guys will probably churn over into other companies that are not doing as poorly. So there's that part. Something else we can see here from that supports that thesis. Now we did see an upward revision of the previous report, which was at 225, but it only ticked up a very small amount to 226. And this week's report actually came in lower than that, only at 222. So looks good. We're pretty, aside from last week, we're mostly stable here with the 4-week moving average, staying mostly consistent. So it looks good. Current number versus the 8-week moving average, it's only 5,000 higher. So again, it doesn't look too bad. This the week of November 6th looked more like an anomaly than the start of a new trend so far. We'll see how it goes as the weeks progress, but yeah, this looks pretty consistent there, stable. And looking at the continuing jobless claims, that is, it's ticking upward a little bit more. It is starting to get up closer to those March numbers. It's actually right there at the 20 March number now, and not quite to the 27 March number of 1529. Wouldn't be surprised if it does go up above that level. So that is a little bit of a concern there, but it did revise upward by only 1,000, a very small amount. So usually we, if it's looking worse, economically, I would expect there to be a stronger revision upward than what we're actually seeing there. But yeah, it's very minor right now so far. Usually expect to see the numbers show up in the initial claims data first before they start showing up in here. We're not really seeing that just yet. Like I said, we're looking pretty stable on the initial claims, so I'm not really too concerned about what's going on here personally. All right, now to summarize the data we're going to cover for that reported this last week. I had the producer price index month over month reading. I'm going to go into more detail on that in a minute here, but just to summarize, consensus estimate was for a plus 0.4% month over month performance. We actually got weaker than that, so that was a good thing. I've talked before, I think 0.2 to 0.4 basis point neighborhood is ideal, and that's exactly where we're at there, so that looks good. Next month, they're forecasting 0.3%, so still looks like we're pretty good there overall on the wholesale inflation data, or what's expected from it. Now we'll go into more detail on that as well when I get to that relevant part of this. Retail sales, which we'll also cover here, month over month, they were a little stronger than expected. They were expected to go up to 1% on a month over month basis. They actually went up 1.3% though. Again, it's month over month, and you do expect there to be some increase in activity with the holiday shopping season coming up as well. So keep that part in mind there. And forecast for next month is 0.9% positive. So same ballpark as what was previously expected. And moving on later part of the week, we had housing starts, building permits, preliminary data, and existing home sales data. All of those came in lower than previous numbers, but better than expected. Well, there was not a consensus available for building permits, but housing starts did come in stronger than were expected, and existing home sales were also better than expected. Now, forecast, all expected to drop over next month, and it should not be of any surprise at all. We'll go into more detail again on that when we get to those reports. All right, breaking down the producer price index here. As you see here, we had a pretty good strong trend there between October and June of this year, but since June it is more like a spoon handle thing there, what it looks like if you were to look at it. This isn't stock chart, so we can't work with that, but yeah, we see a much flatter trend here. This looks really good here as far as inflation expectations in the coming months are concerned, because producer prices, that producers usually absorb more inflation than consumers do, and then they'll pass on what inflation to the consumer that they believe they can do, but there is a degree of inflation that they absorb that they do not pass along to consumers. So this is actually this is a good omen actually for a consumer price index in the coming months. It is kind of ticking up some though over the last 2 months here, so that is going to be an argument for more Fed funds rate increase activity in the coming meetings. You know, and I think I might actually support their idea of more and weaker, smaller FFR increases over the next year, as there's been talk about this over this week. A larger number of just 0.25 or 25 basis point rate hikes is what I mean by that. The Fed officials have actually talked about doing that themselves. So this is going to give an argument for that. And we'll kind of cover that again on the next slide here. All right, that same data translated over. I accidentally put the wrong data in this sheet the first time I populated it. So the October 2021 number there, if you're really paying close attention, is not going to be accurate. But I know that the year-over-year increase was 8%. So that should put it in the right ballpark, at least, of what it actually was. You see here, month-over-month percent, we were getting over a percent growth, over 1% for 3 months in a row in January through March. That was too strong. Even in June, it was, May and June, that's too much. But saw declines in July and August, and now we're right there in that, mid 25 or mid 20s basis point neighborhood over September and October. That's exactly what I want to see. Now, this is what the current trend is. Basically, if you project out, going back to this chart here, what I'm comparing is what the price index, what the average change was between this month here, June and October, and then also what the lowest number was, which was right here in August. So that's the steepest that it's been in this trend here. and this is the shallowest that it's been. So I'm looking somewhere in that neighborhood, and that's what you get here is only 7 thousandths of a percent, or 0.7 basis point. Yeah, not even 1 basis point change on if you look at on the shallow end, or up to 33 basis points on the steep end. It's very respectable, very manageable. Yeah, right in that neighborhood I was talking about, where I think it would be best to see it at. If we average that out, it comes out to about 17 basis point, or actually 17 points, not basis points, 17 point increase per month. It's not very much at all. So if we project this up 17 points every month for the next year, then that'll give us our estimate of where to expect this wholesale inventory number to go to as the year progresses. As you see, next month, I would expect it to drop to about 7.1% from the current 8. So it'll still be strong, but as you see here, if we just keep it in that neighborhood where it's at right now on a month-over-month basis, it'll soften itself up on its own without any other help. See here, it's going to come down to 6.6 in December, 5.5 in January, a little over 4.5 in February, and eventually get down to where it's even below 1% in June. So that'll be really helpful for the inflation problem. Looking at U.S. retail sales data, it came in more strongly than the same quarter last year. October of 2021, it was at 0.6%. So definitely stronger now. So this is kind of evidence that consumers still have money to spend, and consumers are not having problems with credit, or are not afraid to spend their money. They're just maybe more selective on what they're spending money on. Like I said, it's definitely a more services-based consumer demand right now. And also just some of the summary data that I got from Trading Economics. I didn't go straight to the Census Bureau data myself. I just kind of summarizing here what you can get yourself from Trading Economics. So I'm going to make sure they get their proper credit. So yes, as retail sales were stronger than expected. And breaking down these numbers, had a 1.3% increase in sales at motor vehicle dealers. Gas stations were up 4.1%, but that had a lot. Higher gas prices had a lot to do with that. So there is that to consider there. If you exclude gas and auto, sales were up 0.9%. Those are the two that are more volatile, by the way. And then other breakdowns, food services and drinking facilities are up 1.6%. So again, people are going to restaurants and bars. That's what that's telling you. There's more activity going on there. And food and beverage stores, that's up 1.4%. So people are out spending their money on food and drink. Non-store retail is up 1.2%. Those are basically like your e-commerce types, and among others. Furniture, that's up 1.1%. Again, furniture tends to be a little more on the pricey side, and people tend to, whether it's you're an apartment or a house, whatever, those are a little bit more pricey and more durable, so they tend to last longer, and there's evidence there. People are spending their money. Building materials, plus 1.1%. Health and personal care, plus 0.5%. Electronics are actually down 0.3%. So that could be that might not be such a good omen for Apple or other tech related companies, but overall, spending is up, and that's gonna give a case for the Fed to continue with their rate hiking activities. The others that were down were sporting goods, hobby, musical, and books. They were down 0.3%. And general merchandise stores were down 0.2%. All right, on a year-over-year basis, looking at these retail sales, you see here, we were very strong at the beginning of the year, extremely strong, like too strong. Softened back up to about 7%. Accelerated to about 10% in July, but has since come back down to 8.27% year over year now, as you see here. would still expect some strength on the November and December reads because evidently consumers still have money to spend, but again, have strong standards to compete against from the previous year. So I don't know. We'll see how that goes. All right, I don't want to go into too much detail on the housing related data because it's pretty obvious what to expect from housing market stuff when mortgage rates are going up. Well, interest, when bond yields are going up, you can expect mortgage rates to also go up, and the more they go up, the less affordable homes are, and I would definitely expect to see a pinch on the housing market here, as we are seeing. Yeah, it is down some more in October, not quite to July's numbers, but it's getting down there. Breaking down this data also that was provided by Trading Economics and U.S. Census Bureau. Single-family homes are down 6.1%. And then multifamily homes, 5+ units, are down 0.5%. So multifamily homes are not down as much. That could be another sign, though, that people are pinching on their money, where people are still spending, but either they're more willing to live in multifamily apartments or homes or condos, whatever, or that's just all they can really afford for housing, or maybe it's there's a lot that could be going on there. Do people prefer to be in homes and just can't afford to be in them, or are they just okay with being in multifamily homes because it's they don't necessarily want to own a house? Consumer habits and philosophies that can vary greatly, so I don't want to read too much into it myself, but generally though, most of the housing starts that are happening are still on the single family side. 855,000 on that side versus 556,000 on multifamily homes. All right, and then breaking down regionally, the Northeast is down 34.7% to 96,000. They're down a lot. The Midwest is down 11.1% to 185,000. The West is down 10.6% to 336,000, and the South is actually up 6.7% to 808,000. So clearly, there's a lot of demand for homes, whether it's multifamily or single family in the South. And on a year-over-year basis, we're down minus 8.8% from last year. Now, a lot of what's going on here is being blamed on material cost increases and on rising mortgage rates. Looking at building permits now, as you see there, they're very weak as well. Only 1.526 million in October. That's the lowest we've seen actually since August of 2020. They're down 2.4% month over month, and I did not record year over year. So, but now breaking down, permits for single family are down 3.6%, and multifamily are down 1%. So not really so much. Not looking so bad there on how strong the decline is there on a month-over-month basis compared to what we just saw in the previous. Well, then again, I might be comparing month-over-month to year-over-year, so let's scratch that. All right, in the West, the West is getting the biggest decline, almost 13% decline in new permits, and their total is 330,000. Northeast is down 7% for a total of 120,000. South again is up 2.4%, and 867,000 permits issued. So there's definitely a lot of strength in that part of the country for housing. And then in the Midwest, that was unchanged, 209,000. And looking at existing home sales, this is down minus 5.9%. Have a total of, as you see there, 4.43 million. This is the lowest number seen since December of 2011. So almost an 11-year low that we're seeing there. It's the ninth straight down month. The last time we had an up month was here between December of 2021 and January, as you see here. Most of this is being blamed, for obvious reasons, on home prices remaining elevated and 30-year mortgage rates being at 20-year highs. Buyers are basically blaming, are saying that prices are too steep for them to be able to afford to buy the homes, or the high interest rates is causing them to be disqualified from loans that they'd otherwise have money to buy for. Inventories are also down minus 0.8%, so you would normally see you should expect to see the median price go up, and it actually did go up plus 6.6%. Median price is up to $379,100. That's again, for the average for the first-time buyer, that's getting priced out of the market for a lot of them, as you can expect. And the number of days that houses are staying on the market before they get sold, it ticked up 2 days from 19 days to 21 days. All right, and looking at the insider sell versus buy ratio here, courtesy of wellwisdom.com. You see here, we're still in that kind of not really set in either direction range. It looks like it might start coming down toward the bull line though, so that could be a good sign there. Again, week from week, these can all change. Even the stuff that's already been previously reported, sometimes these can shift in up or downward directions from where they're already at. So see how things go as the weeks come by. We did see the stock prices rally, but I'll talk more about those when we get to the charts. And looking at truckload freight rate data here from DAT Freight and Analytics. See here, we're still down over 50% year over year that is, and on a monthly basis you were also down a good 10%. Again, that's just too sharp a decline in load posts. That's the loads that are available for truckers to pick up and haul. And on the week they're down 9.4%, so a very strong drop there. It's we're going to see some capitulation there in the trucking market and the trucking industry, I believe, especially with small-time carriers. Once you are running on their own authority, running single truck operations, are going to be most hard hit by this kind of thing going on here. Spot truck posts they were unchanged from last week, and they're actually up almost 20% year over year and 7% since last month. So again, that's going to have a downward push on freight rates overall. Reefer freight actually, the loads actually went up, but dry van and flatbed loads actually are going down. Flatbed is always one I always like to look at, even though I don't haul flatbed myself, but flatbed gets most of their demand from construction industry, military, and farming. So when their loads available are going down that much, that's not a really good sign for the economy. And summarizing that same information onto here, this was yesterday's prices. You see here, van and flatbed both ticked down in price a little bit, but reefer actually went back up just a hair. The average fuel price actually went down a couple of cents per gallon from $5.33 to $5.31. Crude oil prices are on the way back down some again, so I do expect that this will probably drop some more by next week or the following week. So we'll revisit that a week or two from now. And finally, looking at what's ahead next week for economic data coming out of significance, of stronger impact. Have durable goods orders report that'll be coming out on Wednesday. Also on Wednesday will be new home sales and the FOMC minutes. Durable goods orders are currently forecasted to be around the same ballpark as what they were last month, 0.4. They're forecasted 0.3. And new home sales, they were actually above consensus last month, but they are forecasted to drop a little bit. All right, guys, let's look at the charts now. We're going to start with the S&P futures chart. As I previously mentioned, you have a couple of stronger downtrends, longer-term downtrends that we're looking at here. This wider one here, where we could see it continue through. You never know. Or we could end up seeing this more shallow downtrend take place, which could be a sign of a flattening process. And short term we have actually an uptrend here, but how long that'll last, And will it break out through this 200-day moving average? That's another question. 200-day is at the 4069 level right now. We actually got a little bit above 4,000 this week. Got up to a high of 4050 before it found resistance. So it got, might have been some other moving averages in the area, like the exponential or weighted moving average, which I don't really pay enough attention to. I'm using simple average here. There are different calculation methods that they use to figure out these averages, or it could even be a different aggregation period that they're working with for moving averages, or something else there. It could be looking at Fibonacci retracement levels or other technical indicators that could be factoring into why it sold off at 4050. 4050 though is also a good psychological resistance level. So that could also very well be what it was. Well, people just like to work with round numbers, and there might have already been preset sell orders in place here at the 4050 level on the futures side. Now, the futures market actually is in, I get them backwards, I think it's in what you call contango, and I'll explain that in a little bit here. I have to be able to show you that the S&P 500 is what its price is at relative to the futures price. The futures price right now is above the S&P 500. That would actually, I get them backward. There's backwardation and contango. When the futures price is below S&P 500, it's one, and then if it's above the S&P 500, it's the other. So it's above right now. I've actually seen, normally I see it, if I recall, below the S&P 500 when we're in bull periods. So the fact that futures price is still higher on the near side, I'm trying to recall, past experiences looking at this. I don't always compare what the futures price is compared to S&P 500 itself. Generally, I do tend to see it lower though. So the fact that it's higher does kind of give me the impression that maybe futures market might actually be a little bit on the short-term bullish but longer-term bearish side. I don't know. Someone who's more well-versed on the backwardation contango stuff there might be willing to add some input on that. But we did see, it does seem to bounce off of the high end of this shorter-term uptrend channel. Now we might actually get a little bit of support here because you got the 10-day moving average as well as the 100-day, the green line right here. They're both right here at the 39.20-ish level right now, where it actually got down to on the 17th. See here, the price got right down to that 100-day moving average, and then that long stem there tells you it got down to here, and then a bunch of buyers came in and pushed the price back up to here. And on Friday, the price kind of stayed in a more shallow range, but it looks like it might be wanting to find support there. So we'll see how it goes. There's, like I say, there's still plenty of concerns about where the economy is going to go. From my personal perspective on it, I can see both a case for bullishness and a case for bearishness. So I'm not going to be like a perma bull and say that that we're looking in some phony world where we always go up. But at least on the market data here, the chart here, it kind of gives the impression that we might be looking for support here. Might end up getting into a wedge here between the 100-day and the 200-day, which would be in between 39.20 and 40.70-ish range. So look for it to maybe stay a little bit more, maybe on the less volatile side for a short time before the price gets squeezed out in one direction or another by these two averages, or these three averages actually. Now looking at the weekly, same thing going on here. We have you see the short-term uptrend, and got a little bit more room to work with here though before it starts hitting moving average resistance on the weekly. It's looks like up around 41.90-ish level where we're going to start. 41.80, 41.90 neighborhood is where we're going to see the 50 and 100-day averages come into play. It seemed to get a good bounce off the 200-day, so that's a good thing. cross back above the 10 week. I mean, so these are weekly averages. I mean, so will we find support here at the 10 week, which is currently at 37.90. It looks like. So we're about 180 points above where the 10 week average is right now. And like I said, we could still see some more increases up to 4150 to 4200 neighborhood before we see some more firm resistance. All right, so I'm gonna go back to the daily. I'm gonna show you. So this is S&P futures /ES on here, and it's currently at 3971.50. Now, if we look at the S&P 500 itself, we're gonna see that it closed at a lower number by about 6 points, 39.65. As the quarter progresses, there's going to be even more of a gap between the S&P futures price and the S&P 500, because as companies increasingly pay their dividends over the quarter, you'll see the futures price. If the futures price is below S&P 500, you'll see the gap narrow as the quarter progresses. And if the futures price is above the S&P 500, you're going to see the gap widen to even, or the futures price is even higher than the S&P itself when that goes on there. All right, let's look at crude oil prices now. I talked about those a little bit earlier. I did say they're on a downtrend, and here you go. So we got technical resistance here at the 100-day moving average. We are back down to $80 per barrel. Should have a downward effect on gas and fuel prices in the near future. But we got some buying activity right here at $78 a barrel and pushed it back up to about 80. So what's going on here? Don't know. But we had some previous pivot activity in that same neighborhood back in September. I've talked about this before. For the most part, I've talked about it wanting to seem to settle in around $85 to $90 per barrel. So I wouldn't be surprised if it gets pushed back up some. Especially as there's still evidence of consumer demand. As long as there's still consumer demand, we're going to see more demand. Especially for travel. There's already been evidence of consumer demand being mostly driven on the services side, and travel is part of it. So more travel means more gas, more demand on fuel and gas. Going to the weekly, we've got. Look like we got some technical support here at the 100-week average, right around $80 per barrel. Went back, it came actually below there, and then came back up and stopped right around where the current 100-week average is at. And it looked like it found resistance here at the 50-week average as well. So. Still looking at technical indicators, this looks like these are, pretty reliable, at least for short-term moves. Now, sooner or later, something's got to give, something's going to get broken through. Which direction it happens in is where the question marks come up, though. I say there's both very concerning and very positive things to be seeing here. Between crude oil and other data. All right, and looking at the dollar index, the daily price chart here. Didn't really have any particular technical levels up here that it topped out at, but we are starting a short-term, at least so far, kind of getting into a longer-term downtrend here, which is good. Again, I've mentioned in the past where if you get the dollar index up too high, it becomes too much of a double inflation strain on foreign consumers of U.S. goods and services. We did see the upward push right down here at this one, which bottomed out at 105.34. Perhaps this was 200-day moving average based support going on here. Not very strong support, strong movement though, back in the upward direction. So that's kind of a good sign there, I think. Again, want to see deflation come down, but we don't want to see demand drop as well. We want to see inflation come down on freeing up supply issues and not because of weakening demand. And I think lowering the dollar index value relative to other currencies will kind of help, hopefully help keep foreign customers interested in U.S. businesses. And looking at the weekly, we talked about last week's very precipitous drop in the dollar index value because of the softening, the weaker than expected inflation data. Got a little bit of an increase this week, but again, the wholesale inflation number came in weaker than expected, and I do expect, and I talked in last week's update where I expect next month's consumer price index or overall consumer inflation data to come in. I do expect it to drop some more. So like I say, maybe we'll see this follow through until we get down here to the 103 level. We'll see how it goes. All right, well, that wraps up this week's edition of my weekly update, whatever. I know pretty good amount of info to cover here. Again, use the bookmarks in the description if you want to skip past anything here. So otherwise, I hope you got a lot of good information out of this, whether I'm just regurgitating some other information or adding in my own impressions on something, something of some use for plenty of viewers, I hope. All right, so otherwise, I hope you all have a wonderful Thanksgiving, and we'll see you next weekend sometime after Thanksgiving, all right? Thanks, we'll see you then.